Thank you for joining us today for a conversation on financial markets. We've got our entire financial advisory team here for us today to participate in the conversation.
There you go.
Sorry for the technical difficulty there on advancing the slides. As I mentioned, we've got our entire team here today from the financial advisory side to have a conversation with you on the capital markets. So as you can see in the photo, our financial advisory team continued to grow throughout 2021. While most of you have already had a chance to meet them, last year we added Lavia, Jake, and James to our advisory team. We do expect the team to continue to grow in 2022. We're currently interviewing to add an additional member to our team on the operations side. Our growth has definitely been a reflection of both our desire to build a deep bench of talent to serve our clients' varied financial planning needs, as well as our clients continuing to introduce us to their friends and family members who need our help. Well, we are grateful for these introductions, and we're committed to building a team of professionals that are dedicated to serving all of you. So in our conversation today, we're going to discuss past performance. So it's always important that we disclose and remind you that past performance is no guarantee of future results. So a couple of quick items today on how to run Zoom meetings so that everybody kind of gets the most out of this conversation. First of all, you'll see on the screen here a tip on how to view the webinar today. First of all, we would recommend in your far upper right-hand corner that you click on the view icon. And in the drop-down menu, we would recommend that you click on standard at the very top. And then at the very bottom, make sure that it is in full screen. If it says exit full screen, it means you're already in full screen and you can stay as are. If not, go ahead and click on full screen. The next thing I mentioned is that we'd like for this to be a discussion. And so, one tip on how to ask questions. We've got everybody muted so that we can cancel out all the background noise, but we want to make sure that this is an open discussion. So in order to ask us questions, if you just run your mouse down around the bottom of your screen, you'll see that ribbon or toolbar will pop up that's at the bottom of the screen here. If you simply click on the chat icon and you type in your question, that'll come to us and we'll be able to collect questions that way and have a robust Q&A. So we want to encourage you to ask questions. Just please do so through the chat icon. So our agenda today is we want to really go through four things. First and foremost is take a minute to look backwards at 2021 and look at market performance as well as the performance of the funds that we owned in 2021. Then the bulk of our time today we'll spend discussing the current environment. And we're breaking that down into three sections that we're hearing most from clients that they want to learn about. One is certainly current market volatility, given the Russian conflict. Another is inflation and the impact that might have on portfolios and how people might want to think about inflation going forward. And then finally is the bond market and the impact that inflation is having on bonds. And in a low interest rate environment, how should people be thinking about the bond portion of their portfolio? Then we'll talk about updates for 2022. There's some new tax, gifting, and contribution changes that everybody needs to be aware about for 2022. And then finally, we'll wrap up by going through the results of our 2021 client satisfaction survey that most of the people on this webinar participated in last year. So again, robust agenda. We want to encourage you to ask questions. If you popped in late after we started, everyone's muted, so please ask questions through the chat bar. If you run your mouse across the bottom of your screen, the ribbon will come up. Click on the chat icon and please submit your question to us that way.
Perfect. Well, I'll get us started on looking at performance and looking at 2021 to see how did we do in 2021. And really 2021 was no different than what we've seen very similarly over the past 10 years or so, that we've been very fortunate being investors in capital markets, that we've seen substantially good returns across different asset classes. And actually 2021 was a very, very good year when we look at it through that lens. Specifically here on this slide, there's a graph that will show and have some numbers as far as what type of returns did we see across different major asset classes. And so along the bottom of this chart, you'll see the different asset classes that we're referring to. And we'll go through these one by one to see how we've fared over the last 12 months. And keep in mind, this is 2021 data. And this is data specifically of the indexes, not of an actual fund that you could be in. And so first of all, we look at US bonds. US bonds were down minus 1.54%, which is obviously a negative number. And what that has to do, and we'll talk a lot about that later on, is what's going on with the bond market. And a lot of that has to do with the interest rate environment that we're in, and seeing rising interest rates, or the market pricing in rising interest rates. That's nothing out of the ordinary. That happens from time to time. And so we fully can expect years like that in the future. We can also expect more normalized years. If we look at US core equity and US small value in the middle of the screen, those numbers are very good, right? If you've been invested very long, that's almost twice as much as, or even more than twice as much as what you would expect to see from those different asset classes. And so very, very good year. International also very good at 12.62%. Real estate, a fantastic year, showing 31.38% for the global real estate index. Emerging markets was down minus 2.54%. Interestingly enough, I think when I look at this graph, as you can see, very, very good performance from 3 out of the 6, strong performance from international. And if we see emerging down a bit, it's interesting to think about the importance of diversification. And we don't know which asset class is going to do the best, for example, in 2022, but having exposure across all these asset classes is what provides a very good long-term experience as an investor. Now we'll transition to compare, okay, this is what those indexes have done. How did the Aspen management clients do? How did the funds do that most of our clients are invested in? You can see also very good, very strong performance across the board. Bonds, similar story to what you saw in the broad market of US bonds. US core equity, 27.54% for the fund that we use, compared to 25.66% for the general index. And really, one of the best stories of 2021 was looking at small cap stocks, and especially US small value. And if we see US small value, that it was up 39.84%, and this is net return, net of the fees of the mutual fund, compared to just 28.27% of the index. And I say just 28.27%, even though that's an amazing number, but seeing 11% outperformance is something that we're not going to see very often, and very fortunate to have seen that last year. I think it's important to just look at this from a high level and not necessarily focus on one item or the other, but we can see that there was good outperformance, strong performance across the board, and some good outperformance of the funds that Aspen uses. This isn't always the case, right? These funds have different performance than the index because of the tilts that are inherent inside of them. tilting the funds towards value stocks, tilting the funds towards smaller companies over large companies, and also tilting towards higher profitability. That results in the tracking difference, if you will, between the fund and its index. 2021, that really paid off in a big way. In 2020, though, you might remember there was some underperformance. And so we're going to see some periods of potential underperformance, but we need to, the importance of staying consistent with our strategy over the long run. These funds pay off in a big way historically. What's interesting to also think about is, okay, that's what we saw in the index. That's what we saw in the funds that Aspen Capital Management uses. But you can't actually get the return of the index. To get a more apples to apples comparison, let's look at a very low cost index ETF and see what were those returns compared to the DFA funds that you hold in your portfolio. And in the top right, there's a little table of DFA International Core Equity, and we can see what its performance was over the last 1 year and the last 10 years compared to the iShares equivalent of the International Core Equity in the ETF form. Over 1 year, the DFA fund saw 2.64% outperformance, and certainly anything can happen over 1 year, as we've said. But over a 10-year period, we even see a 0.65% outperformance, and really that holds consistent with any time period that you look at over a very long time period. These funds tend to offer a higher expected return based off these tilts. Now there's 6 different asset classes up there, and you can see the data. We don't need to go over each one, but I want you to focus on the green and the red. And so if you look in the 1 year column and see the green numbers, green means the DFA fund with the tilts outperformed that ETF over a 1 year period. Same thing in a 10-year period. And where there's the red in DFA Core and DFA Global Real Estate, that means there was some underperformance. And again, this is just to recognize at a high level that we expect a higher return for tilting the portfolio over the long run. This doesn't always happen year to year, but over the long run, that's what we see.
So James, just if you'll go back real quickly to that previous one, we did have a question that came in. The question that came in was, performance was really strong in 2021. And the question is, how have things held up this year? And I think we'd answer that 2 ways. One, we've certainly seen asset classes have negative returns this year. It's almost the exact opposite. James, if you go back 2 slides and you just look at the 2021 performance, you'll see that US equities noticeably outperformed international and emerging market equities. In the first 2 months of this year, it's really flip-flopped. We've seen emerging market equities outperform international equities, and international equities outperform US equities. So right now, it certainly depends on the day, because we're getting a lot of volatility day to day. But right now, depending on the asset class you're looking at, US equities are down 8-9%, international equities are down 4 to 5%, and emerging market equities have been roughly flat to maybe -1%. So but it certainly depends on the day with the daily volatility that we've seen, and the value tilt in the portfolio that delivered those excess returns that James showed you in one of the previous slides is certainly holding true in 2022 as well. And then lastly, year to date on the bond side, we are seeing some slightly negative returns on the bond side as well. It as well has been volatile as interest rates have risen and then declined again, but slightly negative on the bond side as well.
Great. And another question came in, making sure that these performance numbers on this slide, as far as the funds that that Aspen Capital Management uses, are they net of fees? Yes, they are. They are net of the mutual fund index fees, and that's what we're showing on this slide.
So just to be clear, on this slide, the green bars are net of DFA's expense ratios. Okay, if we go to the next slide, what we're showing you here, again, to create that apple to apple comparison, the DFA numbers are net of their mutual fund expense ratios, and the iShare ETF funds are also net of their mutual fund or ETF expense ratios. So we're creating an apple to apple comparison here where both of them are net of their expense ratios.
And Mike, the only other thing I'll add as a point of clarification on this slide is when we're looking at these 10-year numbers, the outperformance and underperformance figures are annualized. And so if we see like 0.44% outperformance, for example, that's annualized over the 10-year period, not just a flat 0.44%.
So 2021 performance really does illustrate the benefit of volatility, of the severe volatility we saw in 2020. I mean, really, if we look at 2021 for 4 major asset classes to have returns in the double digits following such a volatile year, this really shows the benefit for those who stayed invested and actually received those outsized returns. So I think it's important as we go forward to really appropriately define volatility and to remember that it is not an indicator of permanent loss. Volatility is simply the magnitude of change below or above the mean price of a security. So something to keep in mind as we go forward is to remember that volatility really is just a feature of the capital markets, and it's the very reason that we expect to see market premiums each day that we are in the market. So as you keep that definition in mind, the real question next is, what's normal for volatility? So if we look at the S&P 500, which is a benchmark many of you are very familiar with, it's not the only benchmark, but it's a very easy one to reference. If we look at the period since 1950, we see that there have been 36 corrections in the market. So a correction is really defined as a 10% plus decline. There have been 10 bear markets, which is quantitated based on a 20% plus decline, and 6 market crashes, which is defined as a 30% plus decline. So really what this means on average is, statistically speaking, we would expect a correction once every 2 years. We would expect a bear market once every 7 years, and we would anticipate some sort of a crash every 12 years. So despite this, the S&P 500 since 1950 has generated an 11.53% return on an average annual basis. So the point here is really to be very aware of the sensationalized headlines that you read predicting the next doomsday era, and to remember that even though there's intra-year volatility in the markets, whether that be positive or negative, that doesn't always dictate a negative annual return. And if we pull back even further in terms of a time horizon, since 1926, only 10% of the years have had losses of 30% or greater. And in that same period, 71 years were positive and only 24 years were negative. So again, be very aware of how you read and get sucked into headlines, and remember to think rationally in terms of being a long-term consistent investor to be able to capture these random premiums. That being said, we're not seeing anything in the long-term data, even up until today, that tells us that we are seeing any level of abnormal volatility, and really no reason to change any direction or do anything different than you're already doing as a long-term investor. And I think the key here is to remember to really embrace volatility and be able to withstand the inevitable, the things that we can't plan for, such as financial declines and geopolitical risks. And just keep in mind that volatility is really an opportunity to both rebalance and lock in gains on an annual basis. And when there's severe volatility, it's a great opportunity to take that rebalance and strategically, buy things when they're on sale, so to speak. So now I know probably the next question on everyone's mind is, yes, but what about the geopolitical turmoil that we're seeing out of the Ukraine currently? And I would like to remind everybody that wars and markets have coexisted for hundreds of years. And while the human cost is absolutely unacceptable and horrendous, candidly speaking, the market is indifferent and it reacts accordingly. So what I want to highlight here for you is this slide showing geopolitical sell-offs and how short-lived they are. So if you will look here at the upper right-hand corner of the chart is a key. It shows you the orange bar is this initial sell-off upon the start of the crisis. So obviously this time frame varies with each event. This teal color shows the returns of the market 6 months following the start of the event. And the darker green line here shows the returns 1 year later. So keep in mind, this is after the start of the event, not necessarily upon its conclusion. And what we see on average over time is there's about a 5% average total return 6 months from the event, which goes up to 9% average total return 1 year from the event. So the point here is that global markets are incredibly resilient despite these geopolitical issues. So I wanted to take a moment and just kind of walk through specifically some key events in the recent past. Many of you will remember the Cuban Missile Crisis. That was really something that had the world on the brink of nuclear war in October of 1962. That conflict lasted 13 days. And as you'll see, the markets were surprisingly calm on the brink of such a war, with a sell-off of about 5% initially, and then going on to return 21% 6 months later and 26% thereafter. If we take a look at something a little bit more recently down here in the bottom left corner, we'll look at the Iraq War in 2003, which is when the US invaded Iraq. Stocks decreased, a sell-off of about 3% initially, and then went on to return 19% 6 months later and 27% at the 1 year mark. And of course, I would be remiss if I didn't point to the Ukrainian conflict in 2014, which was the annexation of Crimea. Again, very little response from the market in terms of a sell-off, and you see that rebounded 8%, and again, 12% with the 1 year following. So if we draw our attention to where we are now in the current conflict, Russia invaded Ukraine on February 24th. The S&P saw a sell-off of about 2.5%, and the next day it was back up at 1.5%. So the point being, we're really seeing much of the same today that we've seen historically based on this data. And I think the big takeaways for our clients and long-term investors is really these sell-offs are in fact shorter than the conflict itself. And something interesting to note is some of the worst historical global returns have actually occurred in peacetime rather than in wartime. So the key here is really to maintain your broad diversification and continue to have conviction in your investment strategy in order to stay the course when these type of events happen. So that brings us to really what this means to an investor's portfolio. This is a chart that shows the performance of the S&P 500 index between 1990 and 2020. So you've got 20 years of data here amidst hurricane disasters, terrorist attack, various conflicts across the globe, a credit crisis meltdown, a lot of different events happening in this 20-year period. And yet, if you look here on the far left, if you had put $1,000 into the S&P in 1990, and if you had left it in there by the end of 2020, that would have been $20,451. However, if you had let various events cause you to pull money out and again, wait out the turmoil, right? And be able to pick the best day to go in, that would have forced you to really have to be right twice. You would have had to pick the right day to exit the market, being the high before the unforeseen crisis, and know exactly when to get back in. So the challenge here is that if you don't have a plan, you're going to react emotionally. And the net difference is much more harm than a drawdown. So to give you some perspective, the S&P, the average drawdown of the S&P 500 since 1950 has been negative 13%. If you had pulled your money out on any sort of disruptive, what felt like disruptive volatility, it would have cost you $18,206 had you gotten out of the market and just gone into some sort of a risk-free treasury. Had you decided to go in and out of the market or pull your money at a particular time, you would have missed the 25 best single days, which would have cost you $16,075 versus just staying in. So I think it's really important to remember, both as it has been in the past and as we go forward, volatility is simply a feature of our capital markets, and foreign conflicts are something that are absolutely impossible to predict. So the best antidote to any of this is to simply have a plan, stick with your financial plan, know your horizon, and continue to stay consistent.
So just a reminder, if you'd like to ask questions, feel free to run your mouse over the bottom of your screen, hit the chat button, and enter your questions there. This is Mike again. I wanted to talk a little bit about inflation. Given that we had, I think, 40-year record high inflation in 2021, this is obviously a topic that's on a lot of people's minds. And so we wanted to share with you today some of our thoughts on inflation. Of course, a lot of people would like for us to be able to forecast inflation and tell you exactly what it will be in the future. Most of you know that's certainly not the business we're in. We know that not only can we not accurately forecast things like the market or inflation, but we don't think anybody else can do that either on a consistently reliable basis. But we do think that the market actually tells us quite a bit about what future inflation is likely to be in a fairly reliable and consistent way. So we wanted to walk you through how we look at the markets to determine what we think future inflation will be. So many of you aren't aware, what I'm showing you here is a screenshot from a website. You can actually go to this website on a daily basis. In the bottom right hand of the screenshot here, you'll see the web address, and you can go to this site any day. It's the Federal Reserve Bank of St. Louis, where historically they're calculating, in this case, what I'm showing you is the 5-year break-even inflation rate. Okay, so the break-even inflation rate is a simple measure. People don't always remember that every day in the bond market, investors are predicting what future inflation will be by setting the yield on different fixed income instruments. So there's such a thing as a 5-year inflation rate. That is the market setting its expectations of what it believes average inflation will be over the next 5 years. And then there's also 10-year break-even inflation. And the way this is calculated for 5-year break-even inflation is simply taking the yield on the 5-year treasury bill and subtracting the current yield on the 5-year TIPS or treasury inflation protected bill. And the spread between those two tells you what bond investors are expecting future inflation to be. The reason this can be helpful is you have to remember that hundreds of billions of dollars are invested in global fixed income markets every day. So rather than relying on an economist or a market forecaster to predict what future inflation will be, we prefer to use market prices where market participants are wagering hundreds of billions of dollars a day of either their own money or their institution's money, effectively betting on what future inflation is expected to be. As of yesterday, if you pull this website up, you will see that the market is pricing in average future 5-year inflation of 3.1% a year. So that's obviously substantially higher than the 7 or 8% number that we saw in 2021. But it is worth noting that that is about 50% higher than what we've seen over the last 10, 15, or 20 years, where we've seen inflation that's averaged something around, the high 1s or 2 percentage points. Now, interestingly enough, if you pull up this website and you look at the 10-year expected inflation, it's about 0.5% lower at 2.6%. So clearly what market participants are betting is that inflation will certainly be higher in 2022 than 3%, but that it will regress back to something much closer to that roughly 2.5% number that we've seen over the last couple of decades. So one of the things that we've done is we've said, okay, this is helpful, useful data. One question that we get from clients a lot is, how accurate has it been, right? So what we did is we went back historically and we looked at what at any point in time or at different points in time, what was the 5-year break-even inflation rate effectively pricing in that 5-year inflation would be, and then going 5 years into the future and looking back and seeing what was actual inflation. So if we start on the left-hand side of your screen here, you'll see in 2004, the top number here, the market was pricing in that future 5-year inflation was likely to be 2%. If we go forward 5 years and we look backwards, actual 5-year inflation over that period was 2.7%. If we go forward 2 years into 2006, we'll see the market was pricing in 2.3, actual inflation was 2.2. And then you can sort of go across this chart in 2-year increments and look at the top number. So for example, in 2012, the market was pricing in 1.7, actual inflation was 1.4. So what you can see as you look across this is that it's certainly not perfect, but what you will see is that the market and market participants have actually been reasonably accurate in predicting what future inflation will be, certainly within the sort of plus or minus maybe 0.5 of 1 percentage point range, which is about as accurate as one could hope to be. So the key takeaway here for our clients is we certainly, for all sorts of unusual reasons, had a tremendous spike of inflation in 2021, due to an incredible amount of stimulus that was pumped into the economy. The market today is not expecting that level of inflation to continue at all into the future. And in fact, the market is expecting over the next 5 years and certainly 10 years for inflation to return somewhere back to what it has been, let's say, over the last 10 or 20 years.
Great, thanks, Mike. This is Katie, and that was such a great segue into a discussion around bonds. With the current 10-year treasury yielding less than 2%, clients have been asking some questions about their bond portfolio. Like, why do I own bonds in the first place? Why do I have them in my portfolio right now? If we add in other current conditions affecting markets like rising interest rates, inflation that Mike just talked about, and other general market volatility that Labia talked about earlier, those events have driven additional questions like, am I too conservative? Should I sell bonds and buy more equities? So today we want to do our best to help you understand why you do own bonds in your portfolio and what role they play. So collectively as a society, we're in a challenging era of investing. Not just you, not just Aspen Capital Management, but collectively as a society. The days of taking advantage of a lower risk asset class like bonds and earning 6, 7, or 8% look to be long gone. The market environment is now requiring investors to take on more risk to achieve the same level of returns they have in the past. So take a look right now on your screen at what the market return has been over the last year. As James pointed out earlier in the conversation, you can see US bonds and global bonds both have had negative returns. Now, I do want to point out, again, a bad year for bonds is a bad day in equity markets. So put this into perspective and realize that it was negative, but not a significant decline. Now look at the longer performance over the last 20 years. You can see the average annualized rate of return for bonds in the US were 4.6% and global markets or global bonds at 4.3%. The best year being 10.3 for US, 8.8 for global, and the worst year being negative 2% for US bonds and negative 1.4%. So that was last year. Now let's build a little bit more additional context around why it's such a challenging environment for bonds and overall portfolios. So what you're looking at here now is the 10-year treasury yield graph. Most of our clients have seen this data, but I'm going to kind of walk you through it here if you aren't familiar with the data or if you're looking at it again after a long time from seeing it previously. So let's start with the 1980s. That was kind of the peak of the line graph here. Many remember what interest rates were doing at that time. If you can't really remember, think about the mortgage you had back in the 1980s. I've heard clients say around 16 or 17%. That might help trigger your mind of just how high interest rates were at that time. And then what's happened since that is we've had a declining interest rate environment. Now, remember, interest rates and bond prices are negatively correlated. Therefore, when interest rates decline, bond prices go up. Thus, the last 4 decades have been a really nice tailwind for your bond portfolios. But today we're in a different situation. Rates have fallen and they've fallen to about as low as they can fall. Today, again, the current year treasury yield is at 1.7% or approximately around that. There's not a lot of room from lowering rates now. And that means one thing, rates can just kind of go up from here. So if we look at the current yield, we look at that expected inflation, what the market is priced in for expected inflation, as Mike was just talking about, we see we are in a situation where we could expect bond returns to be negative real returns when we consider inflation. So again, the question is, well, shoot, why should I own bonds in my portfolio at all? Well, I'm going to help kind of remind you of what the role of bonds in your portfolio really is. So if you remember one thing from this conversation, please remember this. We don't own bonds to maximize returns. We own bonds to optimize volatility. So think about it if we use the analogy of a sailboat. Bonds are the sail to your sailboat. Bonds are going to propel you further or grow your portfolio. Your equities are the sail to your sailboat. Your equities are going to propel you further and grow your portfolio. Your bonds are the ballast to your sailboat, and your bonds are going to really stabilize your sailboat in times of volatility or rocky waters. So again, number one reason that you own bonds in your portfolio is for stability and protection. And it doesn't take us, we don't have to go too far back in history to remember a time when bonds really did provide that stability and protection in your portfolio. So right now what you're looking at is January 1st through March 23rd, 2020, and what our clients' portfolios did in that first 3 months of 2020. As we started out the year, nobody really knew about COVID. COVID wasn't on anybody's radar. And then by March 23rd, equity markets were in turmoil. So what you're looking at right here is the red line, that's bond portfolios. They stayed flat for all of that equity, through all of that equity volatility. All of these other colors here, the yellow, blues, pinks, and purples, those are represented by the equities that were in our clients' portfolios. And you can see at the bottom of the market, some asset classes were down 47%. So again, really, those bonds stayed flat. They were stabilizing your portfolio. Imagine if you had 100% equities in your portfolio would be down, around 35% collectively. But with that bond addition into your portfolio, you weren't down near that amount because you had that diversification of bonds. So again, number one reason we have bonds in your portfolio is for stability and protection. Number two reason we have bonds in your portfolio is to, again, optimize volatility and find times to rebalance. So what you're looking at here is 2020 returns by asset class. Again, the red line being your bond portfolio, and these colored lines being the equities. And what we were able to do is say, because bonds stayed flat, we were able to sell those bonds and buy your declining asset classes or your equities when they were 35% on sale. So we rebalanced your portfolio here, and bonds gave us the ability to do that. Lastly, or thirdly, what I'd like to say is bonds are kind of the best option right now to diversify your assets. A client question has been, well, if I might get negative returns on my bonds, why not just hold my money in cash? Well, let's look at 2020 again and look at what cash did. So there you can see what cash did. It stayed flat. So if at the beginning of the year, you would have looked at the 10-year treasury and said, hey, I think bonds are going to have a negative year. I'm going to pull my bonds and put my money into cash. And then we would have experienced this market volatility. Your cash would have stayed flat and your opportunity cost would have been about 6%. So staying invested is a better option versus keeping in cash for the long-term investments, because even with bond markets being fickle as they are right now, they have a better probability of outperforming cash over the long run. So any investor needs to ask themselves, do you seek return or do you seek less volatility? And for our clients, we might even ask you differently. Do you need return or do you seek less volatility? And what I mean by this is we can look to your financial plan to help guide you in your investment decision-making. Your investments are more than just a portfolio, they're a plan. And if you have a plan, your decisions should be easy. If you can meet all of the goals you've set in your financial plan with your current investment allocation and expected return, do you really need to take on more risk? I'll leave you with a saying that we've said before and is a good reminder in times like these. You buy stocks so you can eat well, you buy bonds so you can sleep well. All right, I'll stop there and see if anybody has any questions. Doesn't look like, let's keep rolling. 2022 updates.
Hey everyone, this is Jake Taylor. I'm going to share with you a few important updates that we think are applicable to many of our clients for 2022. We have two main categories here. The first is about the Schwab acquisition and integration of TD Ameritrade that many of you have likely heard about. And the second is some important tax updates. So let me start with the Charles Schwab integration of TD Ameritrade. So for a few years now, you've likely heard us discuss this topic as Schwab acquired TD Ameritrade back in 2019. So over the last few years, they have been working on the integration of TD Ameritrade, but as we know, these are very large firms and it's going to take some time. And we're finally getting towards the finish line as Charles Schwab is informing us that they think the integration with TD Ameritrade should be complete in the second half of 2023. So only about a year and a half out if all things go well. Now, at the same time, we're excited about the integration because we think that it's going to allow us to continue to offer a robust and seamless client service experience to all of you. So let me transition to 2022 tax, gifting, and retirement plan contribution changes. So as you can see, we have three main categories here. Starting at the top of this chart, which many of you have probably seen in our most recent newsletters, is the changes to your retirement plan contribution amounts. So we have the 401k employee contribution limit there in the top line. And you'll see there's an increase of $1,000 in 2022 from previous years for both those under the age of 50 and over the age of 50. Now, if you let your eyes go down to the bottom of the chart, you'll see the total retirement plan deferral limit for both employee and employer contributions. So this is the largest change of any of these here on this list, and you'll see that $3,000 increase from $58,000 in 2021 to $61,000 of total contributions in 2022. Our second category, and this is something that many of you will be familiar with, is the annual gift exemption limits. We have an increase from previous years of $15,000 to $16,000 in 2022. And for anyone that's questioning what that is or wondering what that might be, that is the amount that you can give to any one person. It doesn't have to be just family, but anyone you would like before you start to get impacted by estate tax considerations. Our last item here, you'll see the standard deduction increase, again, similar to the 401k contribution limit. We have an increase for both those under the age of 65 and over the age of 65. So you'll see $800 and $900 respectively for that increase in the standard deduction for 2022. So, while these aren't the only updates that are occurring in 2022, we think these are some of the ones that are going to impact our clients and those of you the most.
So this is Mike again. Last thing on our agenda today, we wanted to share with you the results of the client satisfaction survey that we completed in the second half of 2021. First of all, we want to thank you. We know that a number of you, actually probably most of you that are on this webinar, actually participated in the study last year. We actually had roughly 70% of the households that we work with complete the survey. So thank you for your participation. And today I'm going to summarize two key areas of the study with you that we think are important for you to know, because we think it's important for you to see the collective feedback from our clients to us on their satisfaction. First are the results of our Net Promoter Score. So the Net Promoter Score is something that's become sort of the leading metric for measuring client satisfaction across almost all industries. The Net Promoter Score is a highly regarded and widely used customer experience metric that really measures the loyalty of customers to a company. So customers simply answer the question, how likely is it that you would recommend Aspen Capital Management to a friend or colleague? And on the screen here, you can see the results of our study on the far right in the green bar representing Aspen Capital Management. Our score and our response from our clients in the survey was a 93. So just to put that into context, with a Net Promoter Score, scoring of 30 to 70, anywhere in that range is considered to be good. Anywhere between 70 and 90 is excellent, and anything above 90 is considered to be elite. So we, of course, were thrilled with our score of 93, but we were also happy to have a score that's anywhere between 2 and 4 times higher than that of many of our financial services peers. So knowing that we scored exceptionally well versus our financial services peers, we thought it would be interesting to see how we scored versus other major global brands that we know are highly regarded. Brands like Apple, Disney, and Nike. And again, we were exceptionally pleased with the results that you can see. We know that these results have sort of created an expectation that we must continue to deliver on. And then finally, oh, there we go. Finally, our clients ranked their satisfaction with us on 11 different areas, ranging from responsiveness to accessibility to providing personalized service. Of the hundreds of different firms across the country that also participated in the same study, we were happy to have our clients rank us above industry average in 10 of the 11 areas you'll see on the screen. So while we're thrilled with the results, we think it's important that you know that our leadership team is focused on the client experience and working to make sure that we continue to have an exceptional client experience. In fact, this is one of the reasons that we're currently interviewing, like I mentioned at the beginning of the webinar, to add an additional member to our operations team. We've been doing client satisfaction surveys, as many of you know, for nearly 20 years, and our results have always they've always been very strong. We want you to know that we're committed to making the investments necessary to maintain a high level of responsiveness and client satisfaction for both our existing clients and the new families that we'll have the opportunity to work with in the future. We'll be sending you some more information on the survey results via email. But again, I just want to thank you for participating. We try to do this about once every 2 years. It's always really helpful for us to get a high level of participation. And it's important that you know that there are a couple of things that we take out of this every year that with our leadership team, we focus on improving, in the coming year or two. So thank you again for your participation. So with that, we want to be respectful of your time. We've got a few minutes left and we're happy to open it to questions. Again, just enter your questions in the chat bar at the bottom. So it looks like we have a comical question that just came through. Have we moved yet? So for those of you out of town that don't have a chance to come into the office, with the growth of our team over time, we are currently maxing out the capacity of our office space, and we are very diligently looking for new space, larger space. It is one of the crazy outcomes of COVID. We laughed that 2 years ago, no one would have thought that you would have a problem finding commercial real estate as everybody went to work from home. And as it turns out, downtown Boise vacancy is really at all-time lows. So we are diligently looking for new office space, but we're finding it hard to do. Next question that we're seeing, copy of the slides. We will absolutely send you not only a copy of the slides, but we will also send you a link to the webinar. We're recording the webinar today. If you, or maybe a friend or a family member, or maybe someone that you've spoken to about us before that you think might be interested in listening to this, we'll be more than happy to send you a recorded version that'll be on the web, and they can listen to it at their leisure. Just wanted to point out as well, on our website, we will include in that a link to some of our previous webinars. Last year, we did a few webinars, one of which was on cybersecurity. We did that in conjunction with our operations team and the cybersecurity team from Charles Schwab. It was actually the webinar. We've been doing webinars for 15 years. We got better feedback from clients on that webinar than we have any other webinar before. So we would highly encourage you to hit our website, and we'll send you a link. And if you're interested at all in both how we're dealing with your security, how TD Ameritrade or Charles Schwab is dealing with security, or some tips for you personally on how you can deal with security, take a listen to the webinar. So with that, we will bid you a good day. Please be on the lookout for a copy of the slides, a copy of the recording of the webinar, and feel free to forward it on to anyone that you think would actually learn from the information and find it useful. Otherwise, have a great spring. If you have any further questions from today, please feel free to just reach out directly to your advisor. Thanks a lot.